You're listening to the Breakaway Wealth Podcast, the show that helps you build wealth faster, think outside the box, and break out of the herd. Here's your host, Jim Oliver.
Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, Gian Pazzia. Did I say that right, Gian?
You got it.
Pretty close. You just told me 10 seconds ago how to say it, and I almost butchered it. So, Gian, tell everybody a little bit about you and what you do, and then we'll dive into some exciting. Anytime we're talking about saving taxes, it's something I'm excited about, man.
Yeah, so I work for KVKG. I founded the firm, and we help mostly business owners and real estate owners unlock massive tax savings through tax credits, incentives, and proven tax strategies. And we have a handful of different incentives that we kind of focus on, but we've been doing it for over 25 years. We have offices from coast to coast. And to date, we've unlocked over $10 billion of tax savings for our clients.
Wow. Well, I definitely want to talk about that. So let's, so tell me like the top three things that business owners can do, or real estate investors, business owners can do to save tax.
Yeah.
What are the top three?
Yeah. So one of those things is the R&D tax credit, which is highly applicable for anybody that has a software company or producing any type of product, manufacturing. There's a lot of testing and research that goes into that, and a lot of business owners don't realize they can qualify for this tax credit. Another one is with real estate that I'm going to talk more about today is called cost segregation studies, which basically means you get to write off your buildings faster and save taxes by taking those deductions earlier. And so cost segregation, normally you're supposed to write off a building when you, let's say, buy a rental home over 27 and a half years, right? So that's a long time, but not everything in the building lasts that long.
Mm-hmm.
And so a lot of this stuff, things like vinyl flooring, the cabinetry, even stuff outside the building like landscaping, can be written off much quicker. And there's tax rules that essentially allow you to claim most of those deductions in the first year. And so, and so a cost segregation study breaks your building into those different pieces so you can write them all off a lot quicker. And so I like to put numbers to it. And so my example here is, let's say you bought a rental home and you paid $270,000 for it. And let's say you've separated land you're not supposed to write off, right? So all that 270 is your building. You would normally get $10,000 of deductions each year for 27 years. If you do a cost segregation study, you could find as much as 25% of that cost can be written off in the first year. So that now we're talking about almost $54,000. So that's a big delta there of $44,000 of extra deductions by doing one of these studies. And so you're accelerating your depreciation. So it's a time value of money play. But all those sophisticated real estate investors do this.
Yeah. So let me, like when I start to try to think about this, when you, and that makes 100% sense. I have a couple of friends that are making $5-6 million a year in real estate, right? They're always, somebody would say, well, why are they continuing to grow? Why are they buying more stuff? Well, it's because of what you just said, because they literally pay no tax because of using strategies like this. And maybe this might be, I think, the main strategy that they use. So give me like before I go to examples or like case studies or something, does this work for people that are passive real estate investors? Like a doctor might have a full-time job, but
yeah. Yeah, good question. So it can, but it doesn't always work for them. So if you're a doctor and you're making $1 million from your medical practice and you go buy some rental properties, you're not allowed to use the deductions from your real estate against your, we'll call it your active ordinary income. So if you had several properties as a doctor, right, and some of them were spitting off cash and you needed more deductions, you could go buy a property just to accelerate deductions to offset, any taxable income from other properties, right? So that's the situation where a passive investor can definitely benefit, but oftentimes passive investors may not have enough income from their real estate. And there are some strategies that you can utilize to get those deductions, like as a doctor, to be offset against your medical practice, or if you're an attorney. And so, yeah, I could get into some strategies on that if you wanted to talk about that.
Sure. I mean, let's talk about that, and then we'll move on to. I want to ask you about being like a real estate professional, and maybe strategies that if you're a doctor or an attorney and your spouse is, let's say, a stay-at-home spouse or something, maybe you could qualify as a real estate professional.
Yeah. So you hit the nail on the head. In the tax world, if you meet the criteria of being a real estate professional, it unlocks all types of tax advantages for you. And to meet that criteria, you have to be spending 750 hours a year, basically managing properties and being in the real estate business. Not only do you have to spend 750 hours a year, but the other hurdle is that you can't spend more hours in some other business. So that doctor who's spending, let's say they spent 1,500 hours on their medical practice, even if they spent 750 hours doing real estate, they still wouldn't be considered a real estate professional. And so but if you are married to a real estate professional, and you file your tax returns jointly, you can net everything together, and that kind of unlocks a lot of things. So there's a lot of situations where the spouse may be the one managing the properties, and that person, that's all they're doing, and they're spending, again, meeting that criteria we talked about. Now all of a sudden you buy any property and you are able to offset it against any of your active income. So that's one strategy. You obviously you need to have a spouse that's kind of willing to do that.
Yeah.
But and then the other one that is kind of less known is, so in the tax code, they generally consider buying real estate a passive activity. And when you're buying, rental properties and you're leasing them for a year or longer, it's considered long-term rental property, and you're supposed to depreciate it over 27 and a half years, like I talked about. The rules are a little different when it comes to short-term rentals. It actually falls in this different category in the tax code. And for short-term rentals, it's more like operating a hotel, right? Because that's what hotels are. They're short-term rentals, less than 30 days. And when you fit into that category, now you're supposed to depreciate your buildings over 39 years. So a hotel, you depreciate it over 39 years. A Airbnb property, also 39 years, but it's no longer fits into that same category. And so now the rule to be considered to materially participate in that kind of business is only 100 hours. You only have to work 100 hours in that activity if it's a short-term rental property, and you can use those deductions against you can net them together with your other income. So yeah, that one if you Google short-term rental loophole, you can find out a lot more about that strategy, but that one's kind of another one out there.
So let's pivot a little bit to commercial real estate. And I know that you do some energy tax incentives. And so like, how can commercial real estate owners or people that are interested in getting in that space stack cost segregation with energy incentives like 179D or 45L?
Yeah. Yeah, for sure. So multifamily developers is actually, this one's kind of more lucrative one. If you're building any kind of multifamily development or like condo developments, student housing, whatever, even affordable housing, if you're building it and it's considered energy efficient, you get up to $5,000 in tax credits per unit. Okay, so you build a 100-unit building, that's $500,000 of potential tax credits. Now there's criteria that kind of goes into that, but that one's definitely one to look at, and you can stack that with cost segregation. You get your tax credits, you also get your accelerated depreciation, and then the other one that you mentioned, 179D, works for every other commercial property. So if you have an industrial building, whatever, office building, and that one is worth up to, I want to say it's like $5.60 a square foot.
Wow.
It's adjusted for inflation, but it's not a tax credit. This one's a deduction. And so let's say you have a warehouse and you replace all of the lighting in your warehouse. If you're just doing the lighting, the incentive is less than $5. But if you built it from the ground up, you can get up to $5 a square foot. And then any other kind of retrofits, whether it's HVAC, insulation, lighting, that kind of thing, can qualify as well.
So I love this, Gian. It's like so many people out there have a CPA that is, for lack of a better term, they're filling out the forms, right? They're, hey, show me this, show me that. And they don't want to come up with anything creative because they think, well, if I come up with something and I do actual tax strategy and this person gets audited or something, and I know cost segregation is, I don't even have to ask this question, because in the IRS code, it tells you this is how you account for this, right? This is how you depreciate it. And so it's in the tax code. This is how you're supposed to do it. So it wouldn't get you more audited than something else, right? It's not like some of these other strategies that are out there right now that might get you audited. But like, why do you see that? Like, why don't CPAs tell more of their clients about it?
Yeah, that's a good question. I've been working with CPAs for 25 years. And, I've gotten to know the business. And in fact, for a while there, I had ownership in a CPA firm, so I really understood the business. But the tax code is so massive, right, Jim? And it's impossible for CPAs to know everything in the tax code. It just is. And so there's a number of reasons. One, they just can't keep track of it all. They just can't. Like those credits, the energy incentives that they talk about, most CPAs, that's not even on their radar, right? Because they're dealing with small businesses. And so maybe, if you're going with a CPA and all they do is real estate, you have a better chance of them understanding these incentives. But if you're just dealing with a CPA that, he takes any type of client, he's got some of these clients, some of those clients, like every industry has their own like things going on. And that's where it starts to get impossible, right? I do think AI is going to help in the future, but back to your question, why are they reluctant? They're so busy just trying to service all their clients. CPAs, I think in general, are not the best business people. Like they're not great at leveraging. they're just kind of like client to client, and they're just trying to get through their tax returns. They find out all the information usually right around January, February, March. That's their busiest time of year. They don't really have time to talk to their clients and really give them great advice. They're just trying to get to the next tax return so they can meet their deadline. So number of reasons why this stuff gets overlooked.
Yeah.
My best advice is use a CPA that focuses on your type of business. That gives you the best chance of finding someone that really understands the different things that apply to you.
I love that, man. I love that because, I used to live up in South Dakota and right across the border from Iowa. So all the doctors that served these two hospitals in Iowa, they lived in South Dakota and they had a surgery center there because no state income tax, right? So anything that they could do in South Dakota, meet with patients, do procedures, anything not subject to income tax. In Iowa, it was like 5 or 8% or whatever the heck it is. And so I always think about doctors, and doctors think that they make a lot of money, and I know that they really don't make as much as they make a lot as a W-2 or, a 9-to-5 professional. But, when you look at people that are in real estate and business owners, et cetera, I always think when I hire a CPA, I want to know, do they have any rental real estate? Do they own any other businesses? Because I want to know my CPA is wealthy, right? And because I feel like then they kind of get what I'm trying to do. And if they say, well, there is no way for you to pay zero tax. Well, I don't believe that that's true. I mean, maybe it's not zero, but it should be less than 10% effective or somewhere around that range, in my opinion. So what are the top 3 levers someone earning over 500 grand a year should pull to reduce their tax bill starting this year?
Well, look, so first off, I'm not a CPA, right?
Yeah, right.
I should, kind of tell your audience my background. I'm actually a structural engineer that fell into tax. So I've been working in this business for a long time. And I know kind of my areas of tax. I can tell you, some of the strategies we just talked about are excellent, right? There's tax solar credits that you can buy that can be a good investment for the right situation. I don't know that I'm the best person to be asking that question,
right.
Jim.
All right, no, that's fine. I'll move on from that question. I just had some, I have some questions that just were on my mind. I kind of like I write these things down while we're talking. And so just, I'm thinking, okay, what?
Yeah.
So do you ever have somebody that maybe what I would consider, and you're not saying this, but I would consider somebody maybe with a scarcity mindset around tax planning that's too afraid to take some of these legal deductions? Do you ever get that? Like they go, John, I don't want to do this. I mean, what if what if they get audited or something?
Yeah. Yeah. No, I was just on the phone for an hour yesterday with somebody. Exactly that. Like asking me about the risk of audit. And, it's funny because look, I'm in this business and I don't want to like sell anyone on doing anything that's risky. But with cost segregation specifically, this one's been around literally for like over 50 years. There's court cases that litigate the stuff inside certain types of buildings and how it should be treated, literally over 50 years. And so if you were doing cost segregation 30 years ago, yes, you might have gone to tax court to litigate it. Yeah. Today, you even mentioned it, the IRS has come out with a whole guide. It's called a cost segregation audit technique guide, right?
Yeah.
And it's what they use to train their agents to look for when they look for these studies. And I can tell you, really, it's going to come down to they want to know who did the study. Did you hire a reputable firm and that firm follow all the steps that needed to be followed to get this thing done. And so, yeah, you want to make sure that you're using a reputable firm that's been around a long time, that is going to be around if it gets looked at. And look, we do 3,000 studies a year. And, this is what I was telling the guy on the phone yesterday when he asked me, that we do, 3,000 a year, probably. So in the last 3 years, let's say we did 10,000 studies. We've probably gone under audit like 15 times. So the percentage it's less than even the percentage of just getting audited, right? So I think the percentage of just getting audited might be like, I don't know, 0.5%. This is even, according to my numbers, even less than that.
So, and again, I've worked with a lot of people that are real estate investors and a lot of people and showing them infinite banking. And when I've seen it is some people think you can do it yourself, that you can do the cost segregation yourself, right? I've seen that. Or they use like what I would call low quality cookie cutter firms, right? Obviously, you've saved people billions of dollars. You've been doing this for a long time, your firm and you. And so that's the thing. Or I see like aggressive assumptions, like 5 or 15-year property, stuff like that, right? So like, but one thing that I tell people about any strategy, and I don't know, again, I'm not a CPA either, okay? So I'm not giving tax advice, but the IRS can't disprove something you can prove, right? And also, the IRS, I don't know, most people don't know this, but you know how much it costs to go to tax court? $60, right? Or that's what it was when I went, because I got audited and I said, okay, let's go to tax court. It was $60 to file. And guess what happened? All of a sudden, then we start negotiating. They won't negotiate. You go to tax court for $60. Now we're going to negotiate. You know where my court date was in Las Vegas. Okay. I didn't have a ticket to Las Vegas. It was 2 days from when, I knew, my CPA knew, we're going to settle this thing, right? It was like, we're not going to court. So I think sometimes we're afraid of the IRS, but this is one of the things not to be afraid of. If it's done right and you have good paper trails and all of that stuff, if it's done wrong, if anything's done wrong, it's a neon sign saying audit me. You know what I mean? Yeah. And so, I appreciate what you're doing. So how does somebody contact you? Do you have how do they get more information about what you do and how they should interact with you?
Yeah, sure. By the way, I love your story about, going to tax court. I agree. I had a similar situation. I was headed to tax court with a client and same thing, took it all the way up to 2 weeks before we were going to federal tax court in Washington, D.C. And that's when they negotiated and they basically conceded on, we got like 90% of what we were, of everything that they were trying to get. So IRS
they don't want to go to court, by the way. They do not want to go to court.
They don't want to go to court when they know they have a chance to lose, because once it's on the record, that opens up the floodgates. They would rather just not put it on the record, right? Because once it is, forget it. They lose that case every time. Anyway, so for us, you can communicate with me by going to costsegregation.com. That's our website. And you can, find my contact information if you have a property. I also wanted to say, Jim, we have a software that allows for smaller residential properties.
Yep.
Your listeners can actually use and do the cost seg studies it's essentially like TurboTax for cost seg.
Oh, wow. I didn't even know that existed. Okay.
Yeah. So it's designed for smaller residential properties, like 4 units and under, with a tax basis of $1.5 million or less. And for $500, they can go through and essentially walk through, get their cost sig study done. And we've been through IRS audit with that.
Sweet.
And the key to being successful under IRS audit with that is, it's essentially making the person put in all the correct information about their property. It only takes 15 minutes to use, but we've been under IRS audit 3 times, 0 adjustments, and we've been launched since 2016. So I actually have a code here that your listeners could use if they want to get a 10% discount here. Again, go to costsegregation.com, and the code is breakaway 2025. That's all caps. So breakaway 2025, all in caps. You'll get a 10% discount to try that software if you have a property for first-time users.
Awesome. Thank you so much for that. And audience, there's a lot of people that are sitting out there. Maybe they're not in real estate, right? And they're thinking, well, why would I go out and build a portfolio of real estate? And we talk about real estate versus Wall Street and all of these things, John. But and you're kind of in this area in LA that I think of how many billionaires have been created in just Southern California from real estate. And then how many millionaires, right? I mean, it's just crazy. I know somebody has 1,000 doors just in just Los Angeles. And my background originally was I was a financial babysitter. Financial planner for 15 years. And I realized that that's not how my clients became wealthy. They became wealthy with real estate and owning businesses, right? And so when you're going to do that, you have to educate yourself about all the different aspects of, am I going to do multifamily? Am I going to do commercial? Am I going to do industrial? Am I going to do medical, whatever it is, but having these tools in your tool belt, like cost segregation, which I think is the greatest thing going. And when I've seen everything work right, it's that engineering based detail. And so the fact that you're an engineer, that's I commented on your shirt, your Purdue shirt, when we first got on line. And, it's like having an engineer, because I'm not a detail guy. So that's why that stands out to me, because you don't want me doing a cost segregation study. You don't want me to do anything with details. So, I love that you guys are doing this. I love that you're helping people and serving people, and that you've saved so many people tax, because, I tell this story all the time, but I love a few years ago, this is probably 2016, 2018, somewhere in there, is I was walking by the TV at this place and they had the Today Show on. And I don't care if you love him or hate him, by the way, but they said Donald Trump lost $1 billion over these 10 years. He's a terrible businessman, right? And I thought, oh no, they're going to tell people that, they're going to tell people about depreciation and blah, 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 blah. No, they just wanted to bash Donald Trump. So they didn't educate their audience on here's how he did that to not pay any tax, right? They just wanted to bash him. Again, I don't care if you love him or hate him, but the code, the IRS code, is written for the informed, right? And if you're ignorant, you're going to be a slave to that code. And if you're educated, you're gonna be able to play the game the way the game's supposed to be played. Maybe talk about what you've seen in the past in 25 years with that. Does that make sense, that question?
Yeah, no, you're hitting it on the head. Look, Donald Trump didn't want to show his tax returns, and you're absolutely right. It's 100% because of the depreciation losses, and those depreciation losses are coming from cost segregation. It's a big part of his strategy, and pretty much every billionaire real estate owner is doing this. It's also super flexible, because of when you can choose to do these studies. It's funny, if you bought a building 5 years ago, it's not too late. And so sometimes real estate owners will say, I don't need the deductions this year. I'm going to wait 3 years because I know I'm going to sell that property in 3 years. That's when I'm going to do this cost-seg study and generate all these deductions. So it's most times in tax, you can't like time when you're going to do these things. And this actually allows you to. So from a planning standpoint, that's how you can just never pay tax. And I have clients that, same thing you said, I've learned growing up around accountants and working with these clients that there's a game and the tax code just is slanted. It is slanted towards real estate. Maybe someday they're going to kind of figure that out, but until then, like, that's just, you're right. Like those that are in real estate that understand these rules can pretty much not pay tax if they have a good tax planner and understand the rules.
No, I love that. I mean, it's it's like a monopoly, right? There's only one rule of monopoly that matters: is 4 houses equal a hotel. And Nick Costco, my co-host, Nick and I own a trash business in Louisville and some other businesses together. He was talking earlier today about his daughter playing against his son and him in Monopoly. And she had Boardwalk and she had Park Place. And every time that she passed go, she'd take the $200 and she would buy a house. And after a few turns, then she had on Park Place and Boardwalk hotels. And both his son and him landed on one of those properties. One was $1,700 bankrupt. The other one was $2,000 bankrupt. She knew how to play the game and she was systematic and patient. And I always tell people, real estate is not get rich quick, but it's get comfortable slowly or get wealthy slowly, whatever your goals are. So I'm 100% with you. I really appreciate you educating the audience today. And I'm excited about this question because, again, I have business partners that are engineers, and I love that because I'm like the visionary. I'm the gas pedal. I'm not saying they're the brake, but they're the ones that are making sure we're not going to fall apart at 100 miles an hour, right? And so over your 25 years of being in this business and your whatever number of years being on Earth, what's the best advice anybody's ever given you?
The best advice anyone's ever given me in business is, it's really simple, but it's just do the right thing.
Yeah.
Early on when in the early days of our business, I was younger, and there's always going to be times where you're kind of in that situation where it's like, oh, I could do this, but it's not necessarily like the right thing, right? Every business owner kind of goes through that. Just making sure you do the right thing. You always have your client's best interest in mind, not your own. Make sure you're not trying to sell them on something just to make money if you wouldn't do it yourself. Because, how many times do you come across people that just want to sell you something where it's not really something that's, super ideal? So yeah, just do the right thing. That's my best advice for any young business owners coming up.
You know what I always say is, like, when it comes to doing the right thing, there is no gray area, right? It's either right or it's wrong. And there's lots of books about that. And that's great advice, because if you just say there's no gray area, then you don't allow yourself ever to compromise on that. And so I love that advice. That's great advice. And hopefully that's something that somebody in the audience needed to hear right this minute. Okay, John, last question is, if God came down from heaven and only allowed you to retain the knowledge that you've received from one book, what would that book be?
Yeah, you asked me that question right before the show, and kind of, and I was thinking in my head, one of the more recent books I read.
It can be a couple, by the way. I always say one, but yeah.
Yeah. Well, one of the more recent books I read, my business, we have partners. So a little different than running a business where you're making all the shots, right? When you have kind of a team of partners, it's a whole different story, getting everybody to be aligned. So somebody recommended this book when we were having some issues, just having alignment with our partners. It's called The 5 Dysfunctions of a Team. Have you ever read that one?
Yep.
Yeah, very simple book.
Yeah.
But it was like a game changer if you have business partners where you have to work with them day to day, and just understanding and respecting kind of decisions that are made. It's hard. People don't always agree with decisions, but I think in the book, the whole point of it is look, as long as you voice your opinion, you got to respect the decision of the leader. They're trying to make tough shots. And once you make that decision, you have to kind of roll with it. You can't kind of keep harping on it. So that one for our business was very good.
No, I love that. And, you're exactly right. Working on a team or working as a partner is so much different than just being the solo, making the decisions. It's kind of like when somebody at my country club says, "Hey, you should run for the board." And I was like, no. If you want to make me czar, I'd be a good czar, but I'm not a good committee member. You're going to make me the golf czar. I'll have this place looking good. But we're going to spend a lot of money, and the old guys are going to be mad because they're on budgets. So awesome. Gian, thank you so much. We're going to put in the show notes how to get a hold of Gian and how to check out if cost segregation is right for you, which if you're in the real estate business, meaning you're a real estate investor, because if you're a real estate investor, you're in the real estate business, you have to understand this. You have to do it. It makes sense. There's no way that anybody who's a real estate person out there investing a lot of money would ever not do cost segregation. So the biggest key is finding the right firm that you can work with and the right person and building that relationship and getting educated. So Gian, I can't thank you enough for being on. And audience, like I said, go check it out and see if this is a good fit for you. We're going to wrap this up like we always do with the incredible words of Earl Nightingale and The Strangest Secret. So take it away, Earl.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Thanks for listening to the Breakaway Wealth Podcast. Be sure to subscribe to this show wherever you're listening so you never miss an episode. If you want to start increasing your wealth building ability right now, go to community.createtailwind.com to join our free online community and get access to free, in-depth training designed to help you build real, lasting wealth. See you next week.